Hi everyone, my name is Masud Rahman. I'm an economist working with the UN High Commissioner for Refugees. And if you stayed with us until week 5 of this course, it must be because you were interested in learning about the basics of doing the books for your green venture. Great! Now in this lecture, we will be learning about the fundamentals of one of the 3 most important financial statements, balance sheet. I recommend that you review lesson 5 before watching this lecture. Now lesson 5 already touched upon the basics of a balance sheet. So you already know that a balance sheet presents a snapshot of the financial health of a business at any given point in time. Generally, it is drawn up on the last day of the financial period, be that a month, a quarter, or even a year. Now, investors, creditors, and other stakeholders use balance sheets as a means of evaluating the future potential and worth of a business. The basic formula for balance sheet is assets equals to equities plus liabilities. On one side, we tally up the total assets a company has, and on the other side, we tally up the balance of equities and liabilities of a business. Now, if the two sides are equal to each other, we consider the balance sheet correct, that is, matched. Now let's look at a typical balance sheet and try to read it. When you look at the top of a balance sheet header, you will notice that unlike the other 2 financial statements that you have learned about in lesson 5, balance sheet does not mention the financial year 2020 or something similar. A balance sheet date in the header reads something in the lines of as of the financial year ended June 30, 2020, or the date at which the balance sheet was generated. Now this is because while cash flow and income statements reveal the flow of transactions, sales, revenue, etc. over a period of time, a balance sheet shows the financial health of the business at a specific time and date. As you can see in this illustration, there are 2 types of balance sheet formats available. One is known as the account format. It is called the T format also. In this style, the balance sheet is prepared in a 2-column structure. On the left-hand side, you will list all the assets, and on the right-hand side, you will list all of your liabilities and equities. This is the format learnt about in lesson 5, and also the one you'll have a chance to fill out using the worksheet offered for week 5. The goal is for the left-hand side to match the right-hand side when you're done recording all assets, liabilities, and equities of your business as of the date mentioned in the header. The second format of balance sheets is known as the report format. It is often called the new format as well. It is also known as the vertical format. If you use this format, you will record all the same items as before, but this time you will list everything in the same column. You will begin by recording all assets. After that, you will begin the second section, where you will total all liabilities and equities. Eventually, your total for section 1 and section 2 should match each other in order to have a correct balance sheet, or a matched balance sheet. Now let's look at what each of the 2 sections consists of. On the left-hand side of a balance sheet, you will make a list of all assets. These include current assets, other assets, and fixed assets. What are current assets? These are all the assets that are short-term, or in liquid or near liquid state. What does that mean? It means that they can be converted into cash within the period of the financial year. For example, all cash, cash equivalents, accounts receivables will be considered current assets. Now, all of your inventories which can be sold and turned into cash within 1 year are also called current assets. Another name for current assets is working assets. This is because these assets constantly go through a cycle of being converted into inventory, which in turn is sold for cash again. Fixed assets, also known as non-current assets, are the assets which are long-term, and the full value of which can now be converted to cash within 1 year. For example, the machineries, properties, equipment, and such are usually not easily actualized within 1 year, and are therefore considered non-current assets. Fixed assets are always recorded in the balance sheet at cost value. After this, their depreciation value is subtracted. Then we will get the net value of the fixed assets. We will not be learning depreciation calculation in this exercise, so do not worry about it for now. There's also a third category sometimes included in balance sheets, which is called other assets. Other assets is a big basket for everything that does not fall under current or non-current assets. An example to this could be any intangible assets, which means the assets you cannot touch or see, but they exist nevertheless. For example, the brand value of the business. There are specialized and often arbitrary methods to calculating the value of other assets beyond the scope of this discussion. Now, the final value of total assets is a sum of current assets, non-current assets, and other assets. Now, let's look at the second part of the balance sheet. In this section, you will start with first recording all the liabilities of a business. Anything owed by the business to any creditor or third party other than the owner of the business falls under liabilities category. Just like assets, there are two types of liabilities that we can record. They're current liabilities and long-term liabilities. All the liabilities that must be met and repaid within 1 year period are considered current liabilities. As you learned in lesson 5, this can include accounts payable, expenses that have been accrued by the business, current portion of the debt, which means the amount of long-term debt that is payable in the current reporting period, taxes payable, etc. All the liabilities that do not need to be repaid within 1 year period are considered and recorded under the long-term debt category. For example, if the business mortgage lands that need to be repaid in 10 years, then that loan can be recorded in this section. Now that you have recorded all liabilities to third parties, you will now record the liabilities of the business to its own owners. This section is called equity or owner's equity. If it's a large organization, owner's equity is known as shareholders' equity. All capital stock held by shareholders, retained earnings, will be recorded under this category. Retained earnings are the accumulated gains or income that a business generates at the end of a reporting period. In the end, you will now tally up the total of all liabilities and equity. Did your balance sheet values for section 1 and section 2 match? If they did, you completed a balance sheet correctly. And in case they did not, I invite you to go over lesson 5 again and take advantage of the discussion forums to figure out which part of your balance sheet needs to be revised. Thank you very much for watching.